I received a letter last week from a 67-year-old investor, I'll call him Robert, who just lost 40% of his retirement savings. Not in a market crash, not through fraud, but through three investments his advisor told him were perfect for retirees. Reading his letter brought back a conversation I had in 2008. I was meeting with a group of Oaktree clients, many in their 60s and 70s, who'd watched their portfolios get decimated. One gentleman, tears in his eyes, said something I'll never forget. "Howard, I don't have time to recover from this. A 30-year-old can wait 10 years for the market to come back. I can't." That moment changed how I think about age and investing. Not because older investors need to be more conservative, that's too simple, but because they need to be more thoughtful about what kinds of risks they can afford to take, and more importantly, what kinds they cannot. I'm 78 years old now. I've been managing money since 1969, and I can tell you with absolute certainty, the investment strategies that work brilliantly at 35 can be catastrophic at 65. The problem isn't that people over 60 take too much risk, it's that they take the wrong kinds of risk. So I want to talk about three specific investments that I see destroying wealth for older investors right now in 2025. Not because these investments are inherently bad. They're not, but because they're fundamentally incompatible with the reality of retirement age investing, and because the financial industry keeps selling them to people who shouldn't own them. This isn't about being conservative, it's about being smart. There's a massive difference. Let me start with the first wealth destroyer, and it's going to surprise you because it's something most financial advisors recommend without hesitation. High-yield bonds, junk bonds, below investment grade debt, whatever you want to call them. Now, I need to be clear about something. Oaktree Capital Management, the firm I co-founded, has made billions of dollars investing in high-yield bonds and distressed debt. I've spent my entire career in this space. I understand these securities as well as anyone on the planet. And precisely because I understand them so well, I can tell you why they're often wrong for investors over 60. Here's what most people don't grasp about high-yield bonds. They're called high-yield for a reason. They pay higher interest rates because there's a meaningful probability the issuer won't be able to pay you back. That's not a flaw, it's a feature. It's how the market compensates you for taking credit risk. When I'm managing institutional money at Oaktree, we can handle that risk. We have teams of analysts studying these companies. We're buying hundreds of different bonds to diversify. We have the expertise to work through bankruptcies and restructurings. We can wait years for distressed situations to play out. Most importantly, we're managing money for institutions and endowments that have long time horizons and can tolerate volatility. But here's what happens when a 65-year-old retiree buys a high-yield bond fund because it's paying 7% or 8% when Treasury bonds are paying 4%. They think they're getting extra income. What they're actually getting is a portfolio that will get crushed the next time we have a recession or credit crisis. I watched this happen in 2008. High-yield bonds lost 26% that year. I watched it happen again in 2020 when high-yield spreads blew out during the pandemic. And I'm watching people set themselves up for the same mistake right now. The fundamental problem is this. High-yield bonds give you equity-like risk with bond-like returns. When times are good, you collect your 7% or 8%. But when times are bad, and times always eventually get bad, these bonds can lose 20%, 30%, even 40% of their value. You're taking stock market risk, but you're not getting stock market returns. Think about that for a moment. If you're going to take the risk of losing 30% of your money, wouldn't you rather own something with the potential to go up 100% or 200% when things go well? That's what stocks offer. High-yield bonds offer you all the downside of stocks with a fraction of the upside. For a 40-year-old, that might be acceptable. They have decades to recover. They can reinvest at lower prices if there's a sell-off. They can wait for the cycle to turn. But for a 67-year-old who needs that money to live on, it's a catastrophic mismatch between the investment and the investor's situation. I'll give you a specific example. In March 2020, the average high-yield bond fund lost 22% in a single month. If you were 68 years old and had $500,000 in high-yield bonds, you just watched $110,000 disappear in 30 days. Now, those bonds eventually recovered, if you could afford to hold on. But if you needed to sell to cover living expenses, you locked in those losses permanently. And here's the insidious part. Financial advisors love recommending high-yield bonds to retirees because they can say, look, you're still in bonds. You're being conservative, but you're not being conservative. You're taking credit risk which is one of the most dangerous risks you can take when you don't have the time or expertise to evaluate it properly. The second wealth destroyer is even more popular right now, and it's something I'm seeing everywhere in 2025: dividend-paying stocks chosen purely for their yield. Let me explain why this is so dangerous, because on the surface it sounds sensible. You're retired, you need income, you buy stocks that pay high dividends. What's wrong with that? Everything if you're not careful about what you're buying and why. I've noticed a pattern over my career. Whenever interest rates are low or falling, investors desperate for income start chasing dividend yields without paying attention to the underlying business. They see a stock yielding 7% or 8% and they buy it because it pays more than bonds. They don't ask why it's paying that much. They don't ask whether that dividend is sustainable. They just buy the yield. This is first-level thinking. I need income. This stock pays a high dividend. Therefore, I should buy it. It's simple, it's intuitive, and it's often disastrous. Second-level thinking asks, why is this stock yielding 8% when the market average is 2%? Is the dividend sustainable? What happens to my principal if the company cuts the dividend? Am I actually getting paid for taking a risk I don't understand? I'll give you a real example that's playing out right now. There are companies in the energy sector, in real estate and telecommunications that are paying dividend yields of 7%, 8%, even 10%. Some of these are fine businesses, but many of them are paying unsustainably high dividends because their earnings are declining, their debt loads are too high, or their business models are under threat. What happens when one of these companies cuts its dividend? Two things, both bad. First, you lose the income you were counting on. Second, the stock price usually drops 20% or 30% because all the other yield chasers sell at the same time. So you lose your income and your principal simultaneously. I saw this happen with dozens of companies during the financial crisis. I saw it happen with energy companies in 2015 and 2016 when oil prices collapsed. I saw it happen with retail REITs during the pandemic. And I'm watching it set up to happen again with certain sectors right now. Here's what I've learned. A high dividend yield is often a warning sign, not an opportunity. The market is usually telling you something. It's saying, we don't think this dividend is safe, so we're pricing the stock to reflect that risk. When you buy a stock yielding 8% in a 4% world, you're betting you're smarter than the market. Sometimes you are, usually you're not. But there's an even deeper problem with the dividend-chasing strategy, and it's one that most investors over 60 don't fully appreciate. You're concentrating your portfolio in a way that could be devastating. Think about it. If you're buying stocks purely for their dividends, you're probably overweight in utilities, telecoms, REITs, energy companies, and maybe some financials. These sectors tend to pay higher dividends. But what do they have in common? They're all highly sensitive to interest rates. They're all mature, slow-growing businesses. They're all vulnerable to technological disruption or regulatory changes. So you think you're diversified because you own 20 different dividend stocks. But you're not really diversified. You own 20 similar businesses that will all get hit at the same time when conditions change. That's not diversification. That's concentration masquerading as diversification. I learned this lesson watching what happened to investors who loaded up on high dividend stocks in 2021 and 2022. When interest rates started rising, these stocks got destroyed. Utilities, REITs, telecoms, they all fell 20%, 30%, 40%. The investors thought they were being conservative by buying safe dividend payers, but they were actually taking enormous interest rate risk without realizing it. And here's the cruelest part. When you're over 60 and you lose 30% of your portfolio, you don't just lose money, you lose time. You lose the ability to recover, you lose options. A 35-year-old who loses 30% can work longer, save more, wait for the recovery. A 70-year-old can't. The loss is permanent in a way it isn't for younger investors. Now, I'm not saying dividend stocks are always bad. I own dividend-paying stocks. Oaktree invests in them. But I'm saying you need to buy them for the right reasons, because they're good businesses at reasonable prices that happen to pay dividends, not because you're desperate for income and you're willing to ignore everything else about the company. The third wealth destroyer is the one that worries me most right now in 2025, because it's the newest and the least understood: alternative investments sold to retail investors. Private equity, private credit, hedge fund strategies, structured products, interval funds, non-traded REITs. There's been an explosion of these products aimed at individual investors over the past few years. and I'm seeing them marketed aggressively to people over 60 who are looking for higher returns or diversification. Let me tell you why this concerns me so deeply. I've spent my entire career in alternative investments. Oaktree manages over $170 billion, much of it in alternatives like distressed debt, private equity, and real estate. I believe in these strategies when they're done right, by the right people for the right investors. But here's what I've learned. Alternative investments are not appropriate for most individual investors, and they're especially dangerous for investors over 60, not because the strategies are bad, but because of how they're structured, how they're priced, and what happens when you need your money back. The fundamental problem is liquidity, or rather, the lack of it. Most of these alternative investments lock up your money for years. You can't sell when you want to. You can't get out if you need the cash. You're stuck. For a university endowment or a pension fund, that's fine. They have long time horizons. They can wait. But for a 68-year-old retiree, what happens if you have a medical emergency? What happens if you need to move into assisted living? What happens if there's a family crisis and you need cash? You're trapped in an illiquid investment that you can't exit without taking a massive loss, if you can exit at all. I'll give you a specific example of how this can go wrong. In 2008, I watched people who had invested in non-traded REITs, real estate investment trusts that don't trade on public exchanges, try desperately to get their money out. The REITs had suspended redemptions. The investors couldn't sell. They were stuck watching the value of their investments collapse while they couldn't do anything about it. Some of them needed that money for living expenses. They couldn't access it. That experience taught me something crucial. When you're over 60, liquidity is worth more than you think. It's not just about being able to sell if the price goes down. It's about having options. It's about being able to respond to life's unexpected challenges. It's about not being trapped. But there's another problem with these alternative investments that's even more insidious. You often don't know what they're worth. Private equity funds value their holdings quarterly, and those valuations are estimates. They're not market prices, they're appraisals. And appraisals are always backward-looking and often optimistic. What this means in practice is that your statement might show your private equity investment is worth $100,000, but if you tried to sell it, you might only get $70,000 or $80,000, or you might not be able to sell it at all. You're flying blind, making financial decisions based on numbers that might not reflect reality. I saw this happen in 2022 and 2023. Public market stocks fell 20% or 25%, but many private equity funds barely marked down their holdings. Their investors looked at their statements and thought, great, my private investments held up better than the stock market. But that wasn't reality. It was just slow price discovery. The losses were there. They just hadn't shown up in the valuations yet. For a sophisticated institutional investor with teams of analysts and long-time horizons, this might be acceptable. But for a 72-year-old retiree making decisions about whether they can afford to take a vacation or help their grandchildren with college, it's dangerous. You're making real-life decisions based on numbers that might not be real. And then there are the fees. Oh, the fees. Most of these alternative investments charge 1% or 2% annual management fees plus 20% of the profits. Those fees compound over time and eat away at your returns in ways that most investors don't fully appreciate. I've run the math. Over 10 or 15 years, those fees can reduce your ending wealth by 30% or 40% compared to a low-cost index fund. When you're 40 years old with 25 years until retirement, maybe you can afford to pay those fees if the strategy is good enough. But when you're 65 with 15 or 20 years of retirement ahead of you, every dollar of fees is a dollar you won't have for living expenses. The math is brutal. Here's what really troubles me. I'm seeing these products marketed to retirees with promises of higher returns and lower volatility. You can get stock-like returns with bond-like risk, they say. You can diversify away from public markets. You can access institutional quality investments. It sounds appealing. I understand why people are attracted to it, but it's often not true. The higher returns might not materialize. The lower volatility might just be an artifact of infrequent pricing. And the institutional quality investments? Institutions have access to the best managers with the longest track records. What's being sold to retail investors is often what's left over. I need to be clear about something. I'm not saying all alternative investments are bad. I'm not saying sophisticated investors can't benefit from them. I'm saying that for most people over 60, the combination of illiquidity, opacity, high fees, and complexity makes them inappropriate. The risks outweigh the potential benefits. So what should you do instead? What should investors over 60 own if not high-yield bonds, dividend stocks, and alternative investments? This is where I need to be careful, because I'm not a financial advisor and I don't know your specific situation. But I can tell you how I think about this problem, both as an investor and as someone who's 78 years old myself. The key insight is this. When you're over 60, your primary goal shouldn't be maximizing returns. It should be not screwing up. It should be avoiding the catastrophic mistakes that could derail your retirement. It should be building a portfolio that can survive and support you through the next 20 or 30 years, regardless of what happens to markets, interest rates, or the economy. That means several things. First, you need real diversification. Not 20 dividend stocks that all do the same thing. Not a portfolio concentrated in whatever's paying the highest yield, but genuine diversification across different asset classes, different sectors, different sources of risk and return. Second, you need liquidity. You need to be able to access your money when you need it without taking a huge loss. That means mostly sticking to publicly traded securities that you can sell quickly at transparent prices. It means being very cautious about anything that locks up your money or limits redemptions. Third, you need simplicity. The more complex an investment is, the more ways it can go wrong, and the harder it is to understand what you actually own. I've found that the best portfolios for retirees are often the simplest, a mix of high-quality stocks, investment-grade bonds, maybe some cash, maybe some inflation protection. Boring? Yes. Effective? Also, yes. Fourth, you need to match your investments to your actual needs. If you need income, generate it from your portfolio in a sustainable way, through a systematic withdrawal plan, not by chasing yield. If you need growth, own stocks, but own them because they're good businesses at reasonable prices, not because they pay high dividends. If you need safety, own high-quality bonds, not junk bonds that promise higher yields but deliver higher risk. I think about this a lot as I've gotten older, and my own portfolio has evolved. I take fewer risks than I used to. I own more bonds. I own more cash. I'm more focused on not losing money than on making money. That's not because I've gotten timid. It's because I've gotten realistic about my time horizon and my need for capital preservation. Here's something I've learned that took me decades to fully appreciate. The best investment strategy isn't the one that maximizes your returns. It's the one you can stick with through good times and bad. It's the one that lets you sleep at night. It's the one that won't force you to make desperate decisions when markets are volatile or your circumstances change. For investors over 60, that usually means accepting lower returns in exchange for lower risk, better liquidity, and greater simplicity. It means giving up the chance to hit a home run in order to make sure you don't strike out. It means being content with singles and doubles instead of swinging for the fences. That's not exciting. It won't make you rich, but it will help ensure you don't become poor. And at 60 or 70 or 80, not becoming poor is more important than becoming rich. I want to come back to Robert, the 67-year-old who wrote me about losing 40% of his savings. His story ended better than it might have. He still had Social Security. He still had a pension. He had to make some adjustments, delay selling his house, cut back on travel, work part-time for a few years. But he survived. Not everyone is that fortunate. I've seen people in their 70s and 80s forced to go back to work because they made investment mistakes they couldn't recover from. I've seen people who had to move in with their children. I've seen people whose retirement dreams died because they took risks they shouldn't have taken with money they couldn't afford to lose. That's what's at stake when you're investing after 60. It's not just about returns. It's about your life, your independence, your dignity, your ability to live the retirement you've worked your whole life to achieve. So when someone tries to sell you a high-yield bond fund or a stock yielding 9% or an alternative investment promising superior returns, ask yourself, what happens if this goes wrong? Can I afford to lose 30% of this money? Do I have time to recover? Do I understand all the risks I'm taking? If the answer to any of those questions is no, walk away. There's no investment return worth risking your retirement security. None. I've been doing this for 56 years now. I've made a lot of money for Oaktree's clients. I've also made mistakes. I've learned from both. And if there's one lesson I'd want every investor over 60 to take from my experience, it's this. In investing, what you don't lose is often more important than what you make. The wealth you have at 60 or 65 or 70, that's probably all you're going to have. You're not going to earn it back if you lose it. You're not going to get another chance. So protect it. Be careful with it. Don't let anyone talk you into taking risks you don't need to take with money you can't afford to lose. That's not being conservative. That's being smart. And at our age, smart is what matters most.